5 major pension changes are about to hit millions of people across the United Kingdom starting next month. Some of these changes could cost you thousands of pounds if you are not prepared in advance. Others could actually put more money back into your pocket, but only if you act before the new rules begin. Right now, thousands of pensioners are unaware that their monthly income is about to shift in ways they never expected. The Department for Work and Pensions has confirmed several updates that will affect state pension payments, pension credit, and private pension rules. If you ignore these changes, you could end up underpaying tax, missing a benefit, or losing money you are entitled to. By the end of this video, you will know exactly what is changing, when it happens, and what you need to do about it. Stay until the end, because the 5th change is the one most people have not even heard about yet. These updates are happening because of new government rules being rolled out across England, Scotland, Wales, and Northern Ireland. Every year, the rules around pensions shift slightly, but this year brings several changes landing at the same time. That means the impact on your monthly income could be larger than in previous years. In this video, I will walk you through each change in plain English with real numbers and real examples. Later in this video, I will explain how one simple mistake could see your pension credit stopped completely. I will also show you a quick way to check if you are affected before the new month begins. Let us start with the first major change, because it affects almost every pensioner in the country. The state pension is increasing, and this affects both the new state pension and the old basic state pension. The exact increase depends on inflation figures and average earnings growth recorded earlier this year. For many pensioners, this means a noticeable rise in their fortnightly or monthly state pension payment. However, here's the problem that almost nobody talks about when the state pension goes up. If your income rises even slightly, it can push you over the threshold for certain means-tested benefits. This means some pensioners could lose pension credit, council tax reduction, or housing benefit because their income looks higher on paper. For example, imagine someone named Margaret who receives pension credit alongside her state pension every month. Margaret's state pension increase pushes her total income just a few pounds above the pension credit threshold. Without checking, Margaret could lose her pension credit entirely, along with the other benefits linked to it, like free TV license support. The solution here is simple. Check your new income against the updated pension credit threshold on Gov. UK as soon as the new rate is announced. This way, you can ask DWP for a fresh assessment before any automatic stoppage takes place. But here is the second issue, and this one catches out far more people than you would expect. HMRC is updating the tax thresholds that apply to pension income, including private and workplace pensions. The personal allowance, the amount you can earn tax-free, has been frozen for several years in a row. When your pension income rises, but the tax-free threshold stays frozen, more of your pension becomes taxable. This is sometimes called fiscal drag, which simply means more people get pulled into paying tax without any rule technically changing. According to HMRC estimates, hundreds of thousands of pensioners have been pulled into paying tax for the first time because of this freeze. If you receive a workplace pension or a private pension on top of your state pension, you need to check your tax code carefully next month. An incorrect tax code could mean HMRC takes too much tax directly from your pension payments without you realizing. The solution is to log into your personal tax account on Gov. UK and confirm your tax code matches your actual total income. There is another issue almost nobody talks about, and it involves pension credit eligibility rules themselves. DWP is updating how it calculates certain savings and capital when assessing pension credit applications. If you have modest savings, even a small change in how those savings are assessed could affect your entitlement. For instance, imagine a man named Robert who has around £12,000 saved from years of careful budgeting. Previously, Robert's savings did not significantly affect his pension credit application under the older assessment rules. Under the updated approach, the way that saved capital is calculated could change Robert's final entitlement amount. This does not mean having savings disqualifies you, but it does mean the calculation behind the scenes is shifting. The solution is to use the pension credit calculator on Gov. UK, or call the pension credit helpline directly to get an accurate updated figure. Many pensioners do not realize that even a small pension credit award can unlock other valuable support automatically. This includes help with heating costs, NHS dental treatment, and a free TV license if you are over 75. Missing out on pension credit because of an outdated assumption could mean missing all of these additional benefits too. Now let us move to the 4th change, which affects anyone still paying into a workplace or private pension. The annual allowance, which is the amount you can pay into your pension each year with tax relief, has been adjusted. This matters most if you are still working part-time while also drawing some pension income, which is increasingly common. If you contribute more than the allowed amount in a single tax year, you could face an unexpected tax charge from HMRC. For example, imagine a woman named Diane who works 2 days a week and still pays into her workplace pension. Diane assumes her contribution limit is the same as last year, without checking the updated figure for this tax year. If Diane accidentally contributes above the new allowance, HMRC could send her a tax bill she was not expecting. The solution is to check the current annual allowance figure on Gov. UK before making any additional voluntary pension contributions this year. Your pension provider can also confirm your exact contribution limit if you are unsure how much room you have left. Now here is the fifth change, and this is the one most people genuinely have not heard about yet. DWP is changing how it communicates with pensioners about benefit reviews, moving more checks to digital and phone-based verification. This means some pensioners may receive a text message or an automated phone call asking them to confirm personal details. Unfortunately, this also creates an opportunity for scammers to copy these messages and try to trick pensioners out of personal information. According to Action Fraud, pension-related scams have reportedly increased significantly whenever DWP rolls out new communication methods. A genuine DWP message will never ask you to provide your full bank PIN or your online banking password over the phone. If you receive a message asking for sensitive banking details, the safest action is to hang up and call DWP directly using the number on Gov. UK. This protects your pension income from falling into the hands of a scammer pretending to be a government department. Let us quickly recap everything you need to remember before these 5 changes take effect next month. First, your state pension is increasing, but check whether this pushes you over any benefit thresholds. Second, frozen tax allowances mean more of your pension income could now be taxable, so review your tax code. Third, pension credit savings calculations are being updated, so confirm your entitlement using the official Gov. UK calculator. Fourth, the pension annual allowance has changed, so check your contribution limit before adding extra money into your pension. Fifth, be alert to scam messages disguised as official DWP communication, especially anything asking for banking passwords. Taking just 20 minutes this week to check these 5 areas could protect your income and prevent costly mistakes next month. You do not need to memorize every figure, but you do need to know where to check and when to act. Being informed now means you stay in control of your pension rather than being caught off guard by these changes. If you found this video helpful, please consider subscribing so you do not miss future updates on pensions and government benefits. A quick like helps this information reach more pensioners who may not otherwise hear about these changes in time. And if you know someone who could be affected by any of these 5 changes, please share this video with them today.